Where to invest? Having figured out the reasons to invest, the next obvious question is, where would one invest, and what return can one expect with investing? When investing, one has to choose an asset class that suits the individual's risk and returns profile. For example, one individual will be open to taking a lot of risk with his or her money, while another may want to take moderate risk, while another would want zero risk. Think of an asset class as an investment vehicle defined by its risk and return characteristics. The following are some of the popular asset classes: fixed income instruments, equity, real estate, commodities, precious metals. Fixed income instruments. Fixed income instruments are investment avenues where your principal amount, the money you invest, is perceived to be safe. The entity pays an interest amount on the principal you invest. The bank's fixed deposit scheme is the simplest example of a fixed investment instrument. The interest paid could be quarterly, semi-annual, or annual. The capital is returned to the investor at the end of the investment period, also known as the maturity period. A few examples for fixed income instruments are banks' fixed deposits, bonds issued by the Government of India, also called G-Sec bonds and T-bills, bonds issued by government-related agencies such as GAIL, HUDCO, NHAI, etc. Bonds issued by corporates, Tata, Bajaj, Reliance, Adani. As of October 2022, the typical return from a fixed income instrument, banks FD, varies between 5 to 6%. Government bonds offer about 5.5%, and a few corporate bonds offer nearly 9 or 10%. The rates across different instruments vary because of the risk varies. The government bonds are considered the safest investment, with zero risk to your investment, because, well, the government can't cheat and run away with your money. Corporate bonds are risky, though. Investment in corporate bonds can go to zero, and we have seen plenty of such examples in the past. Equity. Investment in equities involves buying shares of publicly listed companies. The shares are traded on the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. When an investor invests in equity, unlike a fixed income instrument, there is no capital guarantee. However, as a trade-off, the returns from equity investment can be much better. Indian equities have generated upwards of 12% CAGR, compound annual growth rate, over the past 10 to 15 years. Investing in some of the best and most well-run Indian companies has yielded over 20% CAGR in the long term. Identifying such investment opportunities requires skill, hard work, and patience. Real estate. Real estate investment involves transacting, buying and selling, commercial and non-commercial land. Typical examples include transacting in vacant plots, apartments, and commercial buildings. There are two income sources from real estate investments: rental income and capital appreciation of the investment amount. The rental yield typically varies between 2 to 3%, which is not so attractive, in my opinion. The appreciation in land prices is in select pockets and is not uniform. The transaction procedure can be quite complex, involving legal verification of documents. The cash outlay in real estate investment is usually quite large. There is no official metric to measure the returns generated by real estate. Hence, it would be hard to comment on this. Commodity, bullion. Gold and silver are considered one of the most popular investment options. Gold and silver, over the long term, have appreciated. Investments in these metals have yielded a CAGR return of approximately 5 to 8% over the last 20 years. There are several ways to invest in gold and silver. One can invest in jewelry, exchange-traded funds, ETF, or sovereign gold bonds, popularly called as SGBs. Going back to our initial example of investing the surplus cash, it would be interesting to see how much one would have saved by the end of 20 years, considering he can invest in any one, fixed income, equity, or bullion. By investing in fixed income at an average rate of 9% per annum, good corporate bond, the corpus would have grown to 3 rupees and 30 paise CRs. Investing in equities at an average rate of 15% per annum, the corpus would have grown to 5 rupees and 40 paise CRs. Investing in bullion at an average rate of 8% per annum, the corpus would have grown to 3 rupees and 9 paise CRs. Equities tend to give you the best returns, especially when you have a multi-year investment perspective. Many of you reading this may wonder why I've not considered cryptocurrencies as an asset class. When you invest your hard-earned money, you need to ensure enough checks, balances, and regulatory frameworks to protect you as an investor. Crypto lacks all these, hence I'd suggest you stay away from crypto, or any other fancy investment option, till there is a regulatory framework. It is best if your investments have a mix of all asset classes. It is wise to diversify your investment among the various asset classes. The technique of allocating money across asset classes is termed asset allocation, and we will discuss asset allocation later in varsity. For instance, a young professional may take a higher risk given the age and years of investment available. Typically, investors should allocate at least 60% of their investable amount in equity, 20% in precious metals, and 20% in fixed income investments. The percentage mix changes based on risk profile and age. For example, a retired person could invest 80% in fixed income, government bonds maybe, 10% in equity markets, and 10% in precious metals.